3 days ago, SpaceX became a public company. The shares were priced at $135. They opened at $150. By the closing bell, they were near $161, up roughly 19%. For millions of investors, that jump felt like proof. The rocket left the pad. The opportunity was disappearing. Buy now or watch it escape. That feeling is powerful. It is also exactly why opening day is such a dangerous place to make a long-term decision. A first-day pop tells you that demand exceeded the small number of shares available that morning. It does not tell you what the business will earn. It does not tell you what the stock is worth. And it definitely does not tell you what happens when the rest of the shares become available for sale. Rivian is a useful warning. Its shares surged during one of the hottest debuts of 2021. Then the stock lost most of its value as the market stopped pricing the dream and started measuring the business. Other IPOs have looked weak at first and later recovered. The direction of the first session is not a verdict. It is mostly a measurement of attention, scarcity, and emotion. So today, we are not going to predict where SpaceX trades next week. We are going to do something more useful. We are going to measure what a buyer is actually getting, who stood ahead of the public in line, what growth the current price already assumes, and which dates matter after the cameras leave Nasdaq. Let me also be clear about the company itself. SpaceX is not ordinary. It operates the dominant launch platform in the United States. Starlink reaches customers across more than 150 countries. Its engineering record changed the economics of putting mass into orbit. The rockets work. The network is real. The contracts are real. But a great company and a great investment at a particular price are two different questions. Ordinary investors lose money when admiration for the first question replaces analysis of the second. Start with how an IPO actually works. SpaceX did not wake up on June 12th and sell shares to everyone at the same price. The transaction happened in stages. Before public trading began, the company and its underwriters set the IPO price at $135 a share. The offering sold about 555 million shares and raised roughly $75 billion, making it the largest IPO ever completed. Those shares were allocated before the opening trade. Institutions received the largest blocks. SpaceX also emphasized retail participation, giving ordinary investors more access than they typically receive in a famous IPO. But access did not mean everyone got every share requested. Demand was far greater than the amount available. Then the second price appeared. When public trading opened, buyers had to pay what the market demanded. The first trade was about $150. That was already 11% above the IPO price. The shares closed around 161, roughly 19% above it. That difference matters. One group entered at 135. Another group saw the excitement and entered at 150, 160, or more. They bought the same company on the same day, with very different starting odds. The pop was not free money created by the opening bell. It was a transfer. It increased the value of shares already allocated and raised the price paid by buyers arriving afterward. Now look underneath the ticker symbol. SpaceX reported roughly $18.7 billion of revenue for 2025. That is an enormous operating business. But it also reported a net loss close to $5 billion. The company is growing, but the public buyer is not purchasing a mature cash machine. The buyer is purchasing an expensive collection of businesses whose future profits still need to be built. Starlink is the economic center. The satellite network generates most of the company's revenue and the clearest operating profit. Launch services remain strategically important, but the valuation is no longer explained by rockets alone. SpaceX is increasingly being valued as a combination of satellite broadband, launch infrastructure, defense technology, and artificial intelligence. That combination can become extraordinarily valuable. It can also consume extraordinary amounts of capital. Satellites must be replaced. Rockets must be developed. Data centers must be financed. New markets must move from presentation slides into paying customers. The current price assumes many of those transitions go well. At the IPO price, SpaceX was valued at about $1.77 trillion. At the first day close, the market value moved beyond $2 trillion. Compare that with $18.7 billion in annual revenue. At the IPO valuation, investors paid roughly $95 for every dollar of yearly sales. Using the first-day market value, the ratio moved above $100 for each dollar of revenue. A price-to-sales ratio is not a complete valuation model. It does not account for margins, growth, debt, or capital needs. But it is an excellent alarm bell. It tells you how much future success has already been pulled into today's price. For context, even elite technology businesses with large profits usually trade at a fraction of that sales multiple. SpaceX does not merely need to become successful. The price requires it to become one of the most successful businesses ever created, while avoiding the delays, competition, regulation, and capital costs that normally accompany projects this ambitious. Independent estimates show how wide the uncertainty is. Morningstar's post-listing fair value estimate was around $63 a share, less than half the IPO price. Bullish models from ARK Invest have described a path toward a multi-trillion-dollar value by 2030. Both analyses can use thoughtful assumptions and still land worlds apart because small changes in future margins, satellite demand, AI spending, and terminal valuation produce enormous differences today. That spread is the real story. At a normal valuation, you can be somewhat wrong about the future and still earn a respectable return. At an extreme valuation, the future has to arrive with very little room for disappointment. Let's make that concrete. Suppose you bought SpaceX at the $1.77 trillion IPO valuation and wanted to earn 10% per year for the next decade. That is roughly the long-run return many investors hope to receive from a diversified stock portfolio, although no return is guaranteed. After 10 years, the company would need to be worth about $4.6 trillion just to produce that 10% annualized result. Now give SpaceX a generous, mature valuation of 8 times annual sales in year 10. That is still richer than many excellent large companies receive. To justify a $4.6 trillion market value at 8 times sales, SpaceX would need roughly $575 billion in annual revenue. Today, it has about $18.7 billion. Moving from $18.7 billion to $575 billion in 10 years requires revenue growth of approximately 41% every year, compounded for a full decade. Not for one spectacular year. Every year. Starting from an already large base. Through recessions, launch failures, regulatory fights, competitors, satellite replacements, and enormous capital spending. And remember what that result buys you. It does not guarantee that you crush the market. Under these assumptions, it merely gives you approximately 10% a year. The miracle is not the bonus. The miracle is embedded in the entry price. This is why the sentence, SpaceX will be huge, is not enough. The company can become much larger and the stock can still disappoint if the starting price already assumed even more. Now we need to discuss scarcity, because scarcity helped produce the opening day excitement. Only a small portion of the company became freely tradable in the offering. The public float was roughly 4% of the shares outstanding. That means buyers were competing for a thin slice of a famous company while most insider shares remained locked. A small float can make a stock rise rapidly because each new buyer is chasing a limited supply. It can also create the illusion that the market has validated the entire company at that price. In reality, the market has priced only the marginal shares available for trade. Picture a concert with 100,000 people outside and only 4,000 tickets released. The resale price of those tickets might explode. That tells you the tickets are scarce. It does not tell you what happens when tens of thousands of additional tickets are released later. That brings us to the calendar. Most IPOs prevent employees, founders, and early investors from selling immediately. These lockups reduce the risk of a flood of cheap insider shares hitting the market on day one. The restriction does not eliminate supply. It postpones it. SpaceX did not use only one simple 180-day expiration. Its filing describes a staggered structure with multiple release dates. Portions of eligible insider shares can unlock around days 70, 90, 105, 120, and 135. Additional releases are tied to quarterly results. The remaining restrictions generally disappear around the standard 6-month point. There is also a performance trigger. If the stock trades at least 30% above the IPO price for 5 of 10 consecutive trading days before the first quarterly report, an additional portion of insider shares can unlock early. 30% above $135 is $175.50. The stock reached the neighborhood of that threshold almost immediately. That creates a strange incentive built into the deal. The stronger the early price becomes, the sooner more supply may become eligible for sale. The day one pop is therefore not only a celebration. It can also start a clock. This does not mean every insider will sell. Employees may hold. Early investors may remain bullish. Selling can happen gradually. But the buyer should understand the direction of the pressure. Today's market has a tiny float. Over the following months, that float can become much larger. More supply does not automatically cause a crash. Price depends on demand as well. But the early buyer is accepting a simple risk. The current excitement must remain strong enough to absorb billions of dollars of additional shares as restrictions lift. The schedule matters more than the opening day chart because the schedule changes the structure of the market itself. There is another force on the demand side. Major index products may need to buy SpaceX after it becomes eligible for inclusion. Passive funds do not perform the same valuation debate that you and I are doing. They follow an index. When the index adds a company or increases its weight, the funds purchase the required shares. Analysts have estimated that index-related buying could create billions of dollars of demand. That demand can support the price in the short run. But forced buying is not proof of fair value. It is a mechanical transaction. This is important for two reasons. First, a retirement investor may receive indirect exposure to SpaceX through an index fund without deliberately purchasing the stock. Second, the same period of index demand may overlap with a growing insider float. Large institutions may be required to buy while early holders receive scheduled opportunities to sell. That does not make the transaction illegal or deceptive. The terms are public. The problem is that one side reads the filing and plans around the calendar, while the other side watches a green chart and reacts to the emotion of the moment. The information gap is not always secret information. Sometimes it is public information that one group bothers to read. History gives us several versions of this same lesson. Uber reached its lockup expiration in November 2019 while the stock was already struggling. The arrival of additional sellable shares did not create every problem the company faced, but it removed one more support at exactly the wrong moment. The shares touched a record low around the expiration date. Palantir used a different structure, yet its first major release still demonstrated how quickly supply can change the tone of a market. When restrictions lifted, early holders suddenly had the ability to convert years of paper wealth into cash. The stock had passionate buyers, but enthusiasm had to absorb a new category of seller. Snowflake also staggered portions of its lockup. That did not prevent volatility around the final release. Staggering can reduce the drama of one giant cliff, but it does not erase the shares. It spreads the test across several dates. Rivian is especially useful because the company was admired, the story was enormous, and the public offering was celebrated as a new era. The initial excitement could not protect buyers from a valuation that required nearly flawless execution. When production targets, costs, competition, and capital needs became more important than the opening narrative, the stock repriced violently. None of these examples proves that SpaceX will follow the same path. SpaceX has different products, stronger strategic assets, and a larger revenue base. The examples prove only that lockups matter because supply matters. A strong company does not repeal market mechanics. There is also a governance question hiding behind the excitement. Public shareholders receive economic exposure, but they do not receive equal control. SpaceX has a dual-class share structure, and Elon Musk retains overwhelming voting influence. That arrangement can protect a long-term mission from quarterly pressure. It can also limit the power of outside shareholders when strategy, compensation, acquisitions, or capital allocation become controversial. Again, that is not automatically bad. Many founder-led companies used concentrated voting control to make decisions that a short-term market would have rejected. But the buyer should know what is being purchased. You are not buying an equal vote in the future of SpaceX. You are buying a financial claim whose outcome depends heavily on decisions made by a small group you cannot easily replace. Now return to the calendar and imagine the sequence from the perspective of an employee who joined years ago. That employee may have accepted a lower salary in exchange for equity. The IPO finally creates a public price, but the lockup prevents immediate selling. When the first release arrives, selling may have nothing to do with a negative view of SpaceX. The employee may need a house, taxes, diversification, or financial security. The same is true for venture funds. A fund can believe SpaceX remains exceptional and still sell because it must return capital to investors. Insider selling is not always a bearish signal. But the reason for selling does not change the market impact. New supply must still meet a buyer. This is why you should not frame the lockup as heroes versus villains. Early employees earned their shares. Venture investors accepted years of illiquidity. The banks disclosed the rules. The question is not whether anyone is behaving badly. The question is whether the price you pay compensates you for becoming the buyer when all of those rational sellers finally receive liquidity. The source script described retail investors as the last runner in a relay race. The cleaner way to think about it is as a seating chart. The company founders sat down first. Employees and venture funds came next. Institutions received their IPO allocations before public trading. Retail buyers who did not receive an allocation entered after the price changed. Every seat can still enjoy the show, but the ticket cost is not the same. That difference in ticket cost changes the return required from the business. A person allocated shares at $135 needs a smaller future market value to earn 10% than someone who paid $180 or $200. The company is identical. The required outcome is not. This is also why averaging the IPO price into your analysis can be misleading when you never had access to it. Your expected return begins at the price you actually pay. If the stock opens 20, 30, or 50% above the offering, redo every calculation from that higher starting point. The required 10-year value rises with it. At $200 per share, for example, the implied company value would be dramatically higher than at $135. A 10% annual return from that level would require an even larger company a decade later. The story does not become safer because the chart is green. The hurdle becomes taller. So what should a thoughtful investor do with all of this? There are three possible approaches. The first is to chase. You buy because the stock is rising and you fear missing the next Tesla. This approach feels decisive, but it gives the opening market permission to set both your price and your emotional state. You enter after the initial allocation, during the smallest float, before several potential supply releases, at a valuation demanding historic growth. The second approach is to reject the company permanently. That is also an emotional response. SpaceX could build one of the most important business platforms of this century. Refusing to ever reconsider it simply because the IPO price was extreme replaces hype with stubbornness. The third approach is patience. Let SpaceX report as a public company. Watch how Starlink grows. Measure operating margins. Track capital expenditures. See whether the AI strategy produces revenue or merely larger bills. Observe how the stock behaves as lockup tranches expire and the public float expands. Patience gives you more information and costs you nothing. A truly great business does not become unavailable because you refuse to buy during its first week. Amazon, Nvidia, Microsoft, and Apple gave investors years of opportunities. Their long-term winners were not limited to the people who clicked during the opening session. Waiting does not guarantee a lower price. SpaceX may continue rising. That possibility is the price of discipline. You are giving up the fantasy of catching every early move in exchange for avoiding a decision based entirely on scarcity and excitement. Here is the framework I would keep. First, separate the company from the stock. You can admire SpaceX and still reject the current price. Second, calculate the expectations already embedded in the valuation. Ask what revenue, profit, and market value the company must achieve for you to earn an acceptable return. Third, study the share supply. A stock with 4% freely trading today can behave very differently when a much larger percentage becomes sellable. Fourth, mark the calendar. Earnings reports, index decisions, and lockup releases can matter more than the loudest analyst target. Finally, remove urgency from the decision. The market will be open tomorrow. SpaceX will still exist next quarter. A missed trade is not the same as a financial mistake. The loud number on June 12th was the share price. The quiet numbers were 95 times sales, 4% float, $175.50 for the performance trigger, and several release dates waiting on the calendar. Those quiet numbers do not prove the stock must fall. They prove that buying it requires far more than believing in rockets. SpaceX may become one of the greatest companies ever built. At this price, the market is already asking it to become exactly that. I am Jenna. I will see you in the next one.